But look, I want to start with Australia's competitiveness, or rather I should say lack of competitiveness. It should be a matter of national alarm, but somehow the government blithely wanders on without any apparent sense of urgency. That lack of competitiveness was highlighted by the President of the Business Council of Australia at that organisation's annual dinner this week. The guest speaker at that event, the Prime Minister, Anthony Albanese. Senior ministers, including the Treasurer, Jim Chalmers, were also in attendance. They could not have missed this message.
Every CEO in this room, all else being equal, would rather invest $1 in Australia than invest $1 overseas. Every CEO in this room, all else being equal, would rather create a job in Australia than create a job overseas. But things aren't always equal. And right now, Australia is on the wrong side of the competitiveness equation, and we are losing investment to our overseas competitors. The focus post-roundtable must be on making Australia more competitive to drive business investment and to raise living standards. That must be the test.
Now, there's a few things to remember here. Just before the election, S&P Global Ratings warned that Australia's coveted AAA credit rating is at risk. The Reserve Bank has indicated that because of a lack of productivity improvement, our long-term average economic growth rate could be closer to 2.25% rather than its long-term average, around 3%. So that makes it harder to afford all of the social reforms that the Labor government has introduced and which, of course, its voters treasure. To show you this is not just us making up this stuff, just listen to this package of our leading chief executives in Australia laying it on the line about Australia's lack of competitiveness and just how many now are actively seeking opportunity overseas rather than Australia. This comes from interviews we've conducted in the past month.
The last $30 billion US in material investments we've made have been elsewhere. And it's a shame. I mean, it's really a lost opportunity.
Could have you made those investments in Australia? Absolutely.
So the Browse opportunity, very significant gas field. It wouldn't have used all $30 billion. It would have used a chunk of it. Very significant gas resource. The environmental applications to get that approved were also submitted in 2018. So, 7 years in, and we still don't have a line of sight.
When manufacturing capacity goes, it's very unlikely that it would ever return. We saw that with the automotive industry. What you're now seeing in the US on the back of the current administration's tariff position is we have companies from all over the world investing in the US because it is competitive, but also because it's a very large market, so you have the benefit of scale. So that is a real watch out for Australia. If we lose manufacturing capacity here, it won't come back.
At about 45% of our normalised EBITDA actually comes from the overseas market. So we've been able to diversify not only our revenue pool, but our profit pool across multiple markets. So we're not wholly reliant on the Australian market to deliver our business performance, but we have significant expansion plans in Singapore, Vietnam, China, Malaysia, and a few other markets across Asia where our product range is really resonating with those consumers.
Well, of course, every opportunity is an opportunity that we wish to pursue, but there is competition for capital, and that's both within BHP, but also between enterprises. And so the opportunity at Olympic Dam, or Copper South Australia as we call that basin, is competing for capital with other opportunities in the BHP portfolio. And even if they weren't inside the BHP portfolio, the project has to be economic. It has to stand up against other copper supply opportunities around the world.
We do excellent R&D here in Australia, and we get good value from it, but we are still a higher cost place than other parts of the world. And the second part is that the incentives to do R&D for large companies in Australia are 30% below peer countries.
So that goes straight back to the government?
Yeah, well, yes, that's about government policy and government settings. And this is all about other countries being very motivated to attract the sorts of work that we and other big companies do, and putting the settings in place.
Well, look, it is disappointing when I look at a lot of our resources customers. So we provide a lot of critical ingredients to the big Australian resource companies, and it's, I must admit, I feel there's a regret that they seem to be investing more offshore than in Australia. But I can understand that when you look at the comparative tax systems and the different timetable it takes to get approvals. In Wesfarmers, at least, we're deeply committed to Australia. it is hard to navigate some of the investment complexities. It is also frustrating where some of our tax structures create a competitive disadvantage of being based in Australia versus being based internationally. But look, I think we are very keen to control the controllables, face into the opportunities we have. And as you said earlier, I think some of these opportunities with technology and generative AI hopefully will give us the ability to actually drive productivity within our own control rather than necessarily wait around for things to get better.
We've had a very specific strategy to invest in Australia, and we believe in the Australian economy. We believe in the unique position we have here.
But is it tougher?
I think it is tougher, to be honest, yes, no question. But on a relative context, I'm not sure that means it's a worse place to invest. I think arguably it's still the best place to deploy capital from our perspective. From the size of our business and the opportunity, we still see a lot of opportunities to grow in Australia, and that dynamic around a tougher regulatory environment or tougher economic environment is the same environment for everyone else. So if we can apply the same discipline in how we operate and find businesses that have the potential to where we can provide that disciplined execution and unlock value, we can create value for our shareholders, and that is a key focus for us.
And well, one person in a unique position to understand Australia's competitiveness and the importance of our economic growth rate is David Pearl, the former Assistant Secretary of Australia's Treasury. And I spoke with him earlier and asked him what the impact of the loss of competitiveness means to our economy going forward.
It has a negative effect on the Australian economy. There is a global competition for mobile capital, and to the extent that decisions are made in Australia which see capital go offshore, that's a negative. I think the fact that we've lost competitiveness as an economy is undeniable. I think it comes down to a whole series of things, and I'm happy, Ross, to talk to you in detail about some of the policy prescriptions we might want to think about.
OK, so the one thing I would observe is that once upon a time, Australia was protected by the so-called tyranny of distance. It was our disadvantage, but it was also our advantage. But because capital is so mobile now, because creating a multinational business is much easier from a place such as Australia, think Canva, think Atlassian, think so many more of our other big multinational companies, that means that we've got to be more conscious than ever of the movement of capital in and out of the country.
No, that's absolutely right. Even in the past, Ross, as you rightly said, we were protected by the tyranny of distance. Many of the top Australian export earners, from wool in the 19th century through to minerals in the 20th century, benefited from the fact that they were internationally competitive. We didn't become a major commodity exporter simply because we had the resources under the ground or on our paddocks. It was because we were world leaders in efficient production.
So that being the case, what does government need to do to make Australia more competitive, those policies that you were talking about earlier?
Well, the way I think about it, Ross, and the way that we used to think about it in Treasury, and I must admit today's Treasury is a long way from what it was in the past, but working for Ted Evans and Ken Henry before he became an environmental campaigner, we used to discuss it in Treasury. You've got a choice of two economic and political models, Ross. You can adopt the Western European model, which requires that governments direct resources to political ends, massive welfare states that apply to everybody regardless of their income, and high tax burdens. And the results of that are very clear. We're seeing that in Germany, France and Britain, and Australia is following in that track. That might allow you to equalise incomes, but it will be at a lower level, and it slows growth, and it undermines your ability to attract talented labour and mobile capital. The other model is the one that the Australians embraced in the 80s and 90s, and that was bipartisan, and it won many elections. And that was based on not a universal welfare state, but means-tested welfare. It was based on health and education services that were provided by private sector and independent operators who responded to market signals. And it required lower tax burdens, lower income tax burdens and corporate tax burdens. And it's no accident that we had both the Howard government and the Hawke-Keating government signing up to that alternative model, Ross. And it was remarkably consistent. Both cut the top marginal rate, both cut corporate rates, both deregulated industrial relations, and both kept a lid on not only spending and deficits, but the size of government.
So that also led to a higher annual economic growth rate. Our GDP growth rate was much higher, in the 3% for much of that time it averaged. Now it seems the Reserve Bank, and indeed I speak with many economists who say the long-term run rate is probably more likely 2.25%. The problem is if you've got government that has spent a lot of money on social welfare reforms, you need economic growth to pay for that. And if your long-term run rate is much less, it makes it harder not to have debt and deficits as far as the eye can see.
Well, that's right. And you can't tax your way to prosperity. You can't tax your way to higher growth. And one of the most disappointing things is that the modern Treasury and the modern Productivity Commission have lost sight of that. The Productivity Commission, as you and your listeners know, Ross, put out a paper on corporate tax before Jim Chalmers' recent roundtable, which argued that we should increase tax burdens, corporate tax burdens, on the most successful large Australian companies because they supposedly earn rents. Now, what rents mean in economic speak is you can tax their profits up to 100% without affecting their investment. That's just ideological. Whenever it's been tried, it's been a disaster. But that's what mainstream economic agencies are calling for now. Similarly with the welfare state. If you provide universal welfare to the entire population, regardless of income or need, you have to levy a crushingly heavy tax burden on the community. Growth necessarily slows. And you get caught in a trap, Ross. This is what we're seeing in England and France. You've got left of centre governments in both countries that thought they could tax their way to fiscal sustainability. But what happened was that growth was adversely affected, revenues declined, and deficits and debt got worse. So you get caught in a spiral, and that's exactly the one that the Australian government has got us into. And I must say the opposition aren't really offering an alternative either.
So this is going back to the competitiveness and the flow of capital outside of Australia. And that is that it's about the tax burden, it's about the industrial relations laws that make business easier or harder to accomplish. And then it goes to energy prices, with energy prices in America in particular, about a third of those here in Australia, which makes it more desirable to be there in a bigger nation that is likely to be growing faster than here in Australia.
No, absolutely, Ross. And I want to talk a little bit about net zero. And I know that it's not politically correct to do so, but I just want to remind your listeners that if you were an Australian Treasury official in the 80s or 90s, or working in the Productivity Commission, or a professional economist, you would recognise that cutting carbon emissions necessarily reduces growth and living standards. That was the starting point for Australian officials at the Kyoto Protocol, and I was a junior official at the OECD there, Ross, and I witnessed it, where European countries said we had to cut to net zero, and Australia and other dynamic non-European countries, this is in the early 90s, argued that we had to be allowed to increase our emissions because we had young populations, big immigration programs, and heavily fossil fuel dependent economies. So the depressing thing, Ross, is that this was an economic truism that all Australian public servants, all advisors to governments recognised only 30 years ago, that you can't have your cake and eat it too. Sure, you can cut emissions as much as you want, but you're going to cut growth and you're going to lose the competition for investment, as you just referred to with the US. And the fact that we as a political community cannot even acknowledge basic trade-offs means that we can't have a rational policy approach. And unfortunately, we've retreated into slogans which deny any trade-off. And that's the reason countries lose their economic bearings when governments claim that you can have zero emissions, high growth, prosperity, equality of incomes. You can't. Mature communities have to understand that you have to make decisions. Now, climate change is a global issue, Ross. And if 60% of the world's GDP aren't signing up to emissions cuts, and if the US has walked away from Paris, and I guarantee you the US is not going to join again, there's no environmental, let alone economic rationale. And it's depressing to me, Ross, that as a mature community we should have debates about this, but we have a government that's completely blinded by its ideology, and we have an opposition which is afraid to even question the economics of it.
Okay, so then last question for you. Is it too late for Australia from a competitive point of view? Already you've got Standard & Poor's is suggesting that Australia is on the last rung before losing its AAA credit rating, which is much coveted. You've got a situation where you and I can acknowledge that Australia has lost its competitive edge that it once would have had. Is it too late for Australia to avoid a future economic downturn as a result of all of these things we've talked about?
Well, it's fascinating, Ross, because I'm sure you and many of your viewers have been watching closely what's been happening in London and Paris. And there you've got governments that are caught in debt traps. Britain and France are losing the confidence of global investors. The spreads on their bonds, their 10-year bonds, are higher than Greece's. Can you believe that? Mm-hmm. And you've got governments that have tried again and again to tax their way to fiscal sustainability. So we're on that track. Now, the AAA credit rating is an interesting one because in Treasury, we always thought that was never worth the paper it was written on because it takes on faith our public debt projections, our public budget projections. Now, let's unpack those. They basically say that there's no fiscal problem in Australia because they make a number of unrealistic assumptions. One, that government spending will grow at a fraction of what it has over the past 5 and 10 years. So in other words, we'll have an NDIS that's within budget. We know that's not true. Two, that the Australian community, already taxed to the gills, are going to sign up to another decade of bracket creep. Three, we need no increase in defence. And four, there'll be no international crisis. The risk of global stagflation with Donald Trump declaring war on the Fed and the price of gold, which is a hedge against stagflation at a historic high, is extraordinarily high. So if you unpack all of those unrealistic assumptions, Ross, we could find ourselves in fiscal difficulties very, very quickly. So the AAA rating, to some extent, notwithstanding the warnings of the agencies, is not worth the paper it's written on.
I'll tell you what, it is so good to get your insight today, and it really is a dose of reality, not only for government, but for even our own Treasury as well. David Pearl, many thanks for your time.
Thank you, Ross.